Welcome, everyone. So thanks for joining us today as we dive into the impacts of Trump's stunning is a word, 2024 victory and the impact on commercial real estate. So we're going to cover everything from economic shifts to changes in lending and tax policies, the US dollar, the Chinese yuan, treasuries, and even the crypto market. So there's a lot to unpack, right? And I'll try to keep it engaging and to the point. Before we get started, who other than me is suffering from election hangover? Right? Come on, tell me the truth by saying I am in the chat. So let's get some interaction going. And by the way, funny comments in the chat are welcome. This is a judgment-free zone, guys. There are no, there's nothing holy here. Feel free. If you have funny comments in the chat and Anna reads them, she will read them out to me. All right. So you know what makes a webinar like this so difficult? The fact that there is so much to cover, right? Just a massive amount of content is being covered. So I distilled the agenda down to 6 sections. And when I was done with this table of contents, I actually did add a 7th section where I've got everything from the Chinese currency to gold prices to Bitcoin and the US dollar. So let's look at the agenda, right? So even a crystal ball may not work to forecast this Trump economy, but we're going to give it a try anyway. Then we're going to move on to potential regulatory changes because he's promising a lot of those, and he probably is going to make a lot of those. And then we're going to move on to infrastructure, right? So Trump loves talking about those beautiful bridges, beautiful airports, the very best in the world, better than China. So, we'll talk about those and how they may be good for nearby real estate. And then we'll dive into Trump's very potentially explosive trade policies and the tariffs that he's looking to implement to make, all the MAGA crowd happy. And we'll discuss how this affects both the real estate buyers and also real estate developers. And we love speculating about interest rates and lending costs. So of course, we're not going to miss the opportunity to discuss those. And don't forget, Trump is a commercial and real estate developer, right? So last time he was president, we got capital gains incentives, we got opportunity zone gains, and 100% bonus depreciation. So obviously, we got to talk about tax incentives. Starting off with the economic outlook. So Trump's got a very aggressively pro-growth stance, especially with tax cuts and deregulation. And so that could fuel the economy and that could give commercial real estate a solid boost. Demand might increase, especially for the industrial sector, possibly some boost to the office sector as well. But there is a flip side to this. Trade tensions could add unpredictability, especially for foreign investors. So there's potential growth and there's a few twists along the way. And Trump's made it very clear that he wants to reduce the corporate tax rate. So he wants to bring it down to 15%. Currently, it's at 21%. And I think if he does that, the timing is actually going to be good because Europe's looking to raise corporate taxes, and so are many other developed economies. So if we become the only big economy that is lowering corporate tax rates, that's the perfect time for money to flow into the United States. And a lot of that money will end up flowing into real estate. But even if it flows into the general economy, that's going to increase demand for real estate. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neil's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. And once again, we didn't just elect Trump. We gave him both houses of Congress, which means that there's a very high chance, almost 100%, that he's going to help out corporations that gave him a lot of his election donations. Now, the second piece to this is this X factor called Elon Musk. And we all know that Musk is a truly polarizing figure, but objectively speaking, he's got to be one of the greatest CEOs of all time, right? I mean, Steve Jobs had two great companies, right? Apple and Pixar. Elon already has three, right? Tesla, SpaceX, PayPal. And then he has, Neuralink and Boring Company, X, which is Twitter, and potentially X.AI. Those could all be future blockbusters. So if this guy, one of the greatest CEOs ever, starts to make cuts to government as they're talking about very aggressively, it could also have a short-term negative effect to growth because there are 19 million people working in the federal government. And even if they cut government down by 3%, that's 600,000 jobs. So there may be some short-term pain, some short-term job losses, but in the long run, reducing the deficit would definitely make for a stronger dollar and higher treasuries with lower interest rates. So I am, for one, as an independent, hoping that the Republicans use this full mandate that they have wisely, and they actually do some cost cutting with Elon's help, not just playing with taxes for rich people. Here's a quote from a friend of mine, John Chang. He's one of the best known commentators in real estate, and he works at Marcus and Millichap. And he thinks that the pro-growth policies, furthering the tax cuts, the deregulation could stimulate economic activity, could boost demand for commercial real estate. I have to say I'm somewhat skeptical about this, except for any tax benefits, right? Specifically, tax benefits for real estate, which I think could have a very powerful effect on demand. But assume that I'm wrong, John Chang is right, well, and there's a significant boost. In that case, office and industrial sectors are likely to be the big winners. So the office sector is struggling right now. So any boost from corporations taking on more space is going to be welcome. The industrial sector is likely to benefit from the infrastructure and the America First goals that Trump has. I'm personally more bullish on the positive impact on the industrial sector than I am on the office. What about multifamily? Well, that sector's fundamentals are very strong, but if the economy does better in the short term, we've seen the stock market go up, so we could see a boost there. That means more household creation. That means more tenants. However, I do think that the bigger benefits for multifamily may come from the tax benefits, such as 100% depreciation, rather than from a stronger economy. We'll see. Now, I did want to throw in a caution there, Anna. Trump is looking to get into a trade war with China, and that trade war has knock-on effects. It could spread to a bunch of other countries like Mexico or Canada. And this dude, Dr. Sam Chandan, he points out that whenever there's uncertainty, we actually see a drop in foreign investment into US commercial real estate. The Canadians, for instance, are the biggest buyers of US commercial real estate. And the Chinese are not, much far behind. So if there is a big worldwide trade war, that could significantly impact foreign money that is flowing into the US real estate market. Okay, that was the economy. Now on to regulatory changes. We're looking at a reduction in compliance costs. Yay. This speeds up timelines. It opens doors for more projects. Deregulation could mean less hassle, lower expenses for all of us. Trump is a developer himself. He's got a very public dislike of climate policy, which means that he could roll back a bunch of environmental safeguards. That's going to accelerate both commercial real estate development and also development for oil and gas. So let's take a look at that. So he's got this very clear mandate. He's got both houses of Congress. So I think that there's a guarantee that Trump is going to deregulate anything tied to climate change. And that list is miles long. It's endless, but he's going to roll back, methane regulations. He's going to expand drilling. He's going to expand drilling on federal lands. He's going to lift the moratorium that we have on offshore drilling. He's going to expedite all the permitting for oil. He's going to reduce environmental review timelines. He's going to reform the Clean Water Act to reduce the obstacles for energy projects like fracking. And he's going to accelerate LNG, or liquid natural gas, development. So all of this is going to be extremely bullish for Texas, particularly cities like Houston, Midland, and Odessa. And in particular, there's a region called the Permian Basin, and that might experience growth in both residential real estate and commercial real estate. North Dakota is going to be a huge beneficiary. And then you could look at Williston and other cities in the Bakken Shale region. They could see a big resurgence in property values, huge numbers. Pennsylvania could benefit, especially Pittsburgh. So Louisiana could benefit from the massive growth in LNG terminals, especially in the city of Lake Charles. Cities in Wyoming like Casper, Gillette, they could see increased real estate demand because of the natural gas industry expansion there. And Anchorage in Alaska, that could boom if the offshore drilling restrictions are lifted by Trump. And what about us? I mean, good old construction, commercial real estate development. Well, there is some serious good news for developers, right? This guy, Michael Sealer, he's from, College of Williams and Mary. He says, this focus on deregulation could significantly lower barriers for commercial real estate development. Did any of you know that 41% of our current costs for development are tied to just compliance and approvals? 41%. It's not difficult to get that number down from 41% to 30% by just changing regulations. And this is an area that Trump personally knows well. He benefits from it. And I mean, the guy knows he can't get elected for a third term. So there'll be a lot of emphasis on doing things that help his company. All right, moving on to infrastructure spending, right? So as you know, there is actually bipartisan support for infrastructure spending. This is one of the easiest things that Trump can do. Now, it is clear to me right now that they're not looking to claw back the funds that were used for the Infrastructures and Jobs Act. So this was a bill that, the Biden administration passed, but it is very clear that they're going to immediately attack the Inflation Reduction Act, or IRA. So a lot of the funds that were allocated for electric vehicles, electric chargers, all the other infrastructure that supports EVs, those funds are going to get reused. So let's find out what they're going to use this money on. Well, they're going to spend it on this energy dominance focus, right? So expect to see, investments, oil and gas, pipelines, LNG. He's going to also spend money on the US power grid, and that's something that the Democrats are in agreement with him on. And Trump, by the way, likes nuclear. So I'm expecting that he's going to move some of the Inflation Reduction Act money to nuclear energy. And that, by the way, that's good news for Idaho Falls because it has the largest nuclear lab in the country. It's also clear that cities that have big and powerful manufacturing bases, they're going to benefit from this infrastructure push. And the same cities are also going to benefit from the deregulation push because these two things they're tied together. So here's a city, Elkhart, Indiana, right? It's a manufacturing hub. Grand Rapids, Michigan is going to do really well. Expect Reno, Nevada to do incredibly well. I call it the cheapest Californian city in Nevada. See what I did there, Anna? Cheapest Californian city in Nevada, right?
Yes.
Also, Columbus, Indiana. So not Columbus, Ohio. Columbus, Indiana is going to benefit. I do have to mention some other big cities: Detroit, Phoenix. These cities have huge manufacturing bases. A couple others, Chicago could benefit, Dallas, Fort Worth could benefit. So when in doubt, simply ask your favorite AI tool. Mine is Perplexity. Ask it for a list of cities that have large manufacturing bases, right? They're all going to benefit from this. Now, obviously, the money has to come from somewhere, right? So some cities are going to hurt. So Trump's made it clear he's going to pull all the Inflation Reduction Act funds. And he's going to redirect them. So clean energy hubs like Austin, Boulder, San Jose, they're going to lose billions. And coastal cities like Miami, New Orleans, Norfolk, Virginia, these are using IRA funds for the climate adaptation, building seawalls and stuff. All that money is going to be gone. And then you have large cities like Los Angeles and Seattle and Boston. They have these large public transit projects that Democrats write like they're funded by the IRA. So a lot of those projects could just stop, right? Portland, Denver, Columbus, Ohio, they have these very large EV charging network projects, and all of these I think are going to stall. So those are some of the changes that we're going to see. And by the way, when I'm making these kinds of predictions about dozens of cities, I like to check to make sure that other people in real estate feel the same way. So this quote from Richard Barkham, he's at CBRE, he agrees we could see property values increase in areas that are benefiting from the infrastructure focus. Okay, Recently, other webinars, you've seen me talk about the return of manufacturing to the United States. So far, I think all we managed to achieve is that manufacturing is moving from China to Mexico, right? We're seeing some growth in manufacturing in the US, but not a lot, right? But if Trump implements 60% tariffs on China, he changes the manufacturing game completely, right? It's going to force everyone, including the Chinese, to open factories in the United States because they would no longer be competitive if they didn't do that. And while we'll all see much higher inflation, we'll talk about that with these crazy high tariffs, but there's a flip side, right? We get a real, actual increase in US manufacturing capability, right? For obviously, for those of us that are in real estate, this means that we're going to need a shit ton of logistics, a shit ton of industrial warehouses. So let's talk about where those logistics and industrial warehouses would be. Well, similar list of cities like the one I gave you before, Detroit, Houston, Phoenix, but I want to give you some more options. So here's some interesting ones. El Paso, Texas could see increased activity because, Mexico would benefit massively from any tariffs that we impose on China, right? They're the biggest beneficiary. Well, then we would need a massive increase in logistics capacity near the Mexico border. And El Paso, right? It stands to benefit directly. Also, McAllen, which is right near the border. Nashville, Tennessee could benefit. They could see a big growth in industrial rents. Atlanta, Georgia could see significant growth. I live in California, so I want to mention a Californian area that benefits. The Inland Empire is a very crucial logistics hub for goods, and so they might see an increase in demand. Here's a quote from Ken Rosen at UC Berkeley. She says, overall, Trump's going to be good for commercial real estate, but it's going to be very uneven. So in general, I think that the Rust Belt's going to benefit a lot, and so will Texas and Arizona. Expect Washington State, California, Massachusetts to be the losers. All right, moving on. This is an interesting area, trade policies and tariffs, right? So Anna, we've been touching on this so far, but now we're going to take a deep dive into his specific proposals and what they mean for the economy, for inflation, for real estate. All right, so the guy's saying that he's going to enforce a 20% tariffs on all imports into the United States. But if you're China, it's going to be a 60% tariff. And for those of you that don't understand how tariffs work, it's not China paying the tariffs. They're not paying anything. It's the consumer in the United States, right? So, for example, if an Avengers toy costs $10 right now, it's going to cost $16 in the future because most of these toys are made in China. If you're buying a $10 t-shirt that's made in Bangladesh, the t-shirt will now cost $12, 20% more. So as you can imagine, this will immediately within 24 hours increase inflation, right? Nobody argues about that. It absolutely will. If he does go through with the tariffs, then we could potentially see a 1% increase in inflation. So if inflation was going to be 2% a year without tariffs, it would now be 3% a year with tariffs. That is a huge, huge increase, right? And frankly, I'm not sure that we won't see Trump back down if we do start seeing inflation going up that much. Now, where does all this tariff money go? Well, when the US imposes tariffs, the tariffs go to the federal government. And if we implement these tariffs, the federal government could end up with as much as $2.8 trillion, that's 2,800 billion, in additional revenue over the next 10 years. Now, we might not hit that number because Tax Policy Center, it's a right-wing group, they're estimating that because of these tariffs, imports to the United States could actually drop by 15%. That's $5.5 trillion over the next 10 years, right? Because, we would buy less from the outside. But the federal government would still end up with several $trillion in tariffs, and they could spend that on other important things like lower taxes for the rich. In the end, I think these tariffs, they're a delicate balancing act, right? Because you want all this extra tariff revenue, trillions of dollars, but you don't want to spike inflation and you don't want to reduce corporate earnings. Because why? Because corporations now have reduced earnings, right? And reduced margins because of the tariffs, and they will probably reduce the corporate tax collections that the government has. You could also see lower growth because of higher inflation, and we could definitely see higher interest rates because of higher inflation. So this whole thing is a balance and there's lots of pros and cons. What about impact to real estate development? Well, unfortunately, we gave you some good news about development before. Here, the news is not good. Real estate developers, such as my company, we will see increased costs for construction materials. America imports lumber from Canada, so not too bad. But a lot of, doors and windows and faucets and furnaces, they all come from China. So we could see a very significant increase in cost over the next year or two. Now, in the long run, if the tariffs actually work, we could see a boost in domestic manufacturing, and that would lower prices. But I'm not holding my breath for that to happen. I think it's going to take 5 years, possibly 10 years, for us to increase our output dramatically. Spencer Levy, he's from CBRE, is pointing out that tariffs from Chinese goods could lead to both increased construction costs, we mentioned that, but also lead to increased timelines. Now, why increased timelines? Well, because if developers like me, we want to avoid all of a sudden expensive Chinese goods, and we want to get cheaper stuff from Vietnam or India, then we could see much longer lead times from those countries, similar to what we saw during COVID, because it's going to take a while for even Vietnam or India to ramp up. But on the flip side, if these tariffs actually succeed, then we see a very significant boost for domestic manufacturing, for industrial real estate. Again, tariffs are a game changer. If he actually puts in 60% tariffs on China, we're immediately going to see a very big boost in industrial production, right? So I've talked about that. I won't go into it again, but industrial, wow. Okay, moving on. Let's move on to interest rates and to lending. Before I go into the interest rate section, here are 2 minutes on a wonderful investment opportunity that we are offering to our investors. So, this is an opportunity for you guys to make equity level returns with close to debt level risk with cash flows from day one. Avondale Commons is our stunning brand new 320 unit Class A property that we're building in one of the best markets in the country, in Phoenix. Right now, we're in a very strange and small window of time where there are crazy good opportunities for investors that allow both for immediate cash flow and higher returns in a Class A trophy asset like Avondale Commons. I'll tell you why in just a minute. So this is an investment in a superior tier on the capital stack above LP equity. And it takes priority over that regular equity, meaning that every dollar of the $27 million of common equity that we've invested must be depleted, gone, before pref equity investors see any impact. And that unique position in the capital stack, it means higher payment priority, makes it a safer investment. And we have an expected exit in 2 years, so also has the advantage of being a short-term investment, which many of our investors love. So 7 to 8% immediate cash flow starting from day one, and your back-end profits are capped. They're capped at 8 to 9%, but you get your back-end profits before any regular equity payout. So I think it's one hell of a sweet deal. So just a quick review of the returns. You have an annualized preferred return of 15 to 17%. By the way, this offer has been very popular. We already have several $1 million in the bank just in the last, I'd say, 15 or 20 days. So we know that we're going to sell out on this fairly quickly. So 15 to 17% total return, 7 to 8% is cash flow paid out as soon as you invest. Paid out on a quarterly basis, and the rest is accrued and is paid out at exit 2 years from now. Now, in normal times, pref equity rates for this quality of opportunity would be about 9 to 10%, right? But high interest rates, I fully expect them to return back to 9 to 10% within the next year. So good for you. We're in a very advanced stage of construction. Gorgeous property. Phase 1 and 2 should be complete 5 months from now, 4 months now, and Phases 3 and 4 should be completed in September 2025, and construction is proceeding very smoothly. This beautiful property, by the way, the one you see on the screen, is called the Falls at Crimson Commons. It's a sister property to Avondale. It's about 45 minutes away in Phoenix. I'm showing it to you because it has a very similar design to Avondale, right? So we just finished construction, so I can show you final pictures. That'll help you visualize what Avondale will look like in less than 6 months. Also, we raised a tranche of pref equity on the Falls, and the Falls done incredibly well on its construction completion and also on its lease up. So we have a terrific track record of using pref equity money in the same market and using it well. Apartment in the Falls are large and beautiful. Avondale's apartments will be very similar. In case you're wondering why it is that on such a beautiful property, we're raising pref equity, well, it's not needed because of massive construction cost overruns. And the project is not drastically behind schedule. Construction's humming along nicely. It's because of the nationwide increase in cap rates and reduced multifamily market values. We have a bank, it's a friendly bank, they're rebalancing the loan, and they want to reduce the amount of equity that they'll give us from 79 million to 77 million. And they want a couple million in additional interest reserves because because of high interest rates. So it's only because the bank's reducing their loan and asking us for interest reserves that we are adding $4.5 million to the capital stack of pref equity, and that's what's giving you the opportunity. So if you are looking for predictability of cash flow, you don't want to give up the back end profits that come with regular equity, this is a perfect opportunity. Anna's going to throw the link up in chat. We'll also do a poll at the end. You can also let us know about your interest through that. All right. Speaking of interest rates, very tricky, right? Trump's policies, they might keep rates low or forcibly keep rates low to support growth, but then inflation could eventually push the Fed to act, right? If rates go up, financing gets tougher for all of us for CRE projects. But if they stay low, then it's definitely a green light for a lot more development. So this one, again, a real balancing act between growth and cost control. Trump's not even president yet, and we are already seeing a significant upward increase in treasuries. So it should be clear to everyone that Trump's policies, whether it's tax cuts or tariffs, they are inflationary, right? And when inflation goes up, treasury yields go up and interest rates go up, right? So on October 15th, 28 days ago, 10-year treasuries were at 4%. Today they're at 4.43. That's almost a half point or 0.5% jump in just 28 days. Huge jump, right? And that should give you a preview of how this is going to go. Now, does this mean that the Fed is not going to cut interest rates in the coming months? Not at all, right? I mean, Trump actually wants them to cut interest rates, and the Fed only reacts to real inflation, not to some speculation about what Trump's going to do in 3 months, 6 months, 12 months, right? So definitely expect 10-year treasuries to come back down, right? But think of this as a preview. This is a preview of what's going to happen when Trump really gets in the hot seat and starts to implement his policies next year. Now, keep in mind, Trump's also made it very public that he wants to control the Federal Reserve. I'm a successful businessman. I've been successful in business, and I think I have a better gut than the Federal Reserve does. That's Trump, right? That's what he says at rallies. If he succeeds in doing that, then he might force the Federal Reserve to keep rates low, even when inflation is ticking up. And if he does that, he's going to discover it's a very, very bad idea to keep rates low when inflation's ticking up. Because we all just saw what happened when the Federal Reserve made that mistake in the last 2 years. One thing you should know, this dude on the screen, he's going to be out in 2026. In Trump's world, anyone running the Fed has to listen to him. And there's no way Jerome Powell does that. So expect to see the governor out soon. We could see someone from Trump's orbit being made Fed governor. So that person, I think, will have the worst job in America because they're going to need to control inflation. All of Trump's policies are inflationary. And he's going to need to do that in a high, tariff world. So I definitely don't want that job. Now, you can see from this quote, the market today is expecting that Trump's going to pressure the Fed. They're going to maintain lower interest rates. I don't buy it. I generally don't buy anything that this guy says, but I especially don't buy what he's saying here because I think no matter who Trump chooses as a Fed governor, eventually they'll be forced to raise rates if inflation spikes because of tariffs or because of rate cuts, right? That's my 2 cents. And obviously, as a real estate guy, all I can say is I really, really, really hope that I'm wrong. I'd love to be wrong, but I don't think I am. I mean, as an example, let's talk about what we've seen in the last 28 days in terms of treasury yields, right? As you can imagine, that means rates are going up and going down at the same time, right? The Federal Reserve is cutting rates. They cut rates last week. So that's good for development projects that I'm doing because those rates are tied directly to the Fed funds rate, right? So they're seeing reduced interest rates for new construction immediately, right? But for all the value add folks out there, and I buy value add multifamily myself, well, we are seeing rates increase even as the Fed is cutting rates, right? So I run two companies. My development companies are ironically less affected than my multifamily value add companies, right? So we're just not sure which way this is going to go yet. For all you know, Trump could back off from tariffs. No, not really. He's Trump. Okay, on to the other impact section. This is our last section for today. First, I'm going to talk about crypto, right? I'm not sure if a spike in Bitcoin prices is good for commercial real estate. I think it is. I don't really have any data about that. So I'll just say this, right? Trump is definitely good for crypto. So let's talk about that instead of talking about commercial real estate and crypto. So we know by now, hopefully, that Trump's policies are inflationary in nature, right? In an inflationary world, we all need hedges against inflation, and Bitcoin is seen as an inflation hedge. Before the election, Bitcoin was trading in the 60 to 65,000 range, and now it's well over 80,000, right? So tell me in the chat, by the way, tell me in the chat if you made money from Bitcoin in the last 2 or 3 weeks. Tell me that in the chat. All right. And it's not just the inflation hedge angle, right? For the first time ever, we will have an incoming administration that's pro crypto, right? It's not just Trump. There's a number of Republicans that absolutely adore crypto, right? Plus, as this trade war escalates, we could see a very significant volatility in currencies. You know, dollar in Chinese yuan could go up and down like crazy, and some of that money is going to go to crypto. So it's likely that this Congress is going to pass laws that are going to prevent banks and the Federal Reserve from blocking crypto. And they're likely to push digital currencies. All of that is bullish for Bitcoin. For all you know, I mean, we could all be buying, properties in Bitcoin 5 years from now. Okay, other impacts. Oil and energy market. We've touched on it briefly, but we're going to go into it a little bit deeper. So there is zero doubt in my mind that Trump will move very, very quickly to expand drilling and fracking. The first time he was president, he didn't have both houses of Congress with him, right? So he was restricted, but he doesn't have any of those restrictions now. The US currently produces more oil and gas combined than any other country in the world, more than Saudi Arabia, more than Russia, right? Expect even more of that to happen, and definitely expect lower oil prices, right? Oil was already on its way down, and that's happening because of this incredible success of electric vehicles in China, right? So oil demand in China is going downwards. But it's possible. It's possible that we could see prices in the 50 to 55 dollars a barrel range as all of this new production that Trump unleashes comes online 1 to 2 years from now. I'm one of those folks that used to warn folks back in 2008 that the world could run out of oil. And today, I absolutely don't believe it at all. I now believe that we're going to have an oil glut sometimes during this presidency, and overall increased, production. That's Trump's answer to the whole inflation thing, right? So I hope he succeeds, because if we do see oil prices consistently in the 50 to $60 per barrel range, that really could help with inflation, right? I gave you a list of cities that could benefit from increased oil production in the back end, Permian, those kinds of things. So I'm not going to repeat that in this section. All right, let's move on to gold. Yeah, guys, I mean, gold prices, this is driving me nuts. Gold prices are going crazy. This is good for me personally, since I own a fair amount of gold for my portfolio. But it's also scary because India and China, they're not just buying massive amounts of gold, they're moving it, right? So gold obviously is a massive safe haven asset. And when there's a volatility like a trade war, it's normal for investors to buy more gold, right? So today we're seeing central banks are buying gold, pension funds are buying gold, countries with high inflation like Turkey and Pakistan, they're buying lots of golds as an inflation hedge. But what I'm really afraid of is that India and China are buying incredibly large amounts of gold, and then they're moving that gold from its storage vaults in New York and London to their own countries. This means that India and China are losing trust in the international financial system. And Trump has played a very big role in that, right? He's made it very clear that the international order needs to change. Our support for NATO needs to change. We got this America First policy. And basically, Americans just can't be trusted to not weaponize the dollar against China. We weaponized it against Russia in the last 2 years. The US and Europe seized over $330 billion in Russian assets when the Ukraine war started. And so now the Chinese believe that we could seize their assets. So instead of buying treasuries, they're buying gold, right? And this is really bad news for us because China is one of the biggest buyers of US treasuries. And that buyer has just gone away, right? This makes it harder for us to sell treasuries. And we could see much higher interest rates as we finance our multi-trillion dollar deficit by selling, treasuries to other people. And if things get really aggressive with China in this trade war, we could see China dumping treasuries. That could easily double the price of gold if there's a crisis. So there's just a lot of reasons to buy gold in a Trump world. Okay, on to tax incentives. Well, if we see accelerated depreciation come back, that's going to be a big win for CRE, right? Absolutely nothing that Trump can do benefits real estate more than 100% accelerated depreciation, bonus depreciation. That's the magic bullet. That's what Trump's major donors want. And I have a feeling that that's what they're going to get. Obviously, as a real estate developer, as a buyer, I'd be ultra excited if this happens, right? We could see a 50 to 100 basis point decrease in cap rates. And that's about a 20% increase in value over just a single year if accelerated depreciation comes back. So everyone, including me, is praying for that one. And Trump, his cronies, they were all very proud of the Opportunity Zones program during the first, go around 2016. The program has its critics, right? But it's generally regarded as a success by Republicans. So it is possible that we might see an expansion of the program, right? We might just see the sunset date being moved from 2026 to 2030. And if that happens, we could see a very substantial investment in opportunity zones, right? The program's already there. There's already 10,000 opportunity zones defined. So, I mean, it moves very quickly. If they move the date out, a lot of Class C neighborhoods that ended up as Class A neighborhoods, right? The same thing could happen with a bunch more Class C neighborhoods. So watch for this because the moment it happens, you'll start seeing land prices go up in opportunity zones. They will spike like crazy. Okay, let's finish off this webinar about some speculation about the impact of Trump on currencies like the Chinese yuan and the US dollar. If we implement these tariffs, and looks like we're going to implement them. Did you see all of his cabinet picks? They're all anti-China, right? There's just no doubt that the Chinese yuan is going to get a lot weaker, right? And funnily enough, the Chinese government might force it to become even weaker to make their exports more competitive, right? Because they're taking that tariff hit. So this has a positive impact and it also has a negative impact, right? So on the positive side, all those Chinese billionaires, they have a lot of them. They're going to figure it out quickly that the yuan is going to be weak for years. So they will try and get their money out of the Chinese market. And we could see a large surge in capital inflows into commercial real estate. They like buying commercial real estate in the US. So this is going to be one time. It's going to be short, but it could come within weeks of the tariffs being announced. And the tariffs might be announced as soon as, early January. But there's no free lunch, right? So in the long run, this also means that the Chinese buyers will buy less US real estate because the yuan will be cheaper and they'll be able to afford less real estate for the same currency. So because they have less buying power. So nice, huge, big surge next year, right after tariffs are announced, followed by less purchases later on. Now, on the other hand, if the yuan does tank, if it tanks and the Chinese use their policies to keep it weak for years, it could somewhat reduce the effects of the tariffs because it increases our buying power. So it's going to reduce this inflation hit that we're about to take as Americans. Okay, last slide, right? This is interesting. I get this question a lot. I've already had lots of people email me. Will the dollar get stronger or weaker in a Trump administration? That is a very hard question to answer. Trump, he said he wants a weaker dollar because when the dollar gets weaker, our exports get more competitive. But is he actually going to get what he wants, right? So there are arguments on both sides. You guys tell me in the chat, which argument you think is stronger. I'm going to give you 3 arguments to finish. Number 1, there's a guarantee that we get less immigrants. A guarantee, right? That tightens the job market. The dollar tends to do really well when the job market is very tight. So from the perspective of immigration, it's very bullish for the dollar. Argument 2, Trump has made it very clear that the next Fed governor is going to be Trump's bitch. Pardon the bad language, but it's true. So if you're going to get a Fed that's forced to keep interest rates low, the dollar is going to be weak, because if you look at the past, the dollar typically tends to go down relative to other currencies if our interest rates are low. When we raise rates, the dollar goes up, right? So think about that. And then third argument, Trump is, he's committed to these tariffs, right? That has a huge impact. On the good side, whenever there's uncertainty created by all these trade tensions, tariffs, people screaming at each other, investors actually tend to flock to safe haven currencies. We are the biggest safe haven currencies, right? Also, if he really goes in on tariffs, right, really goes in on America's first, well, he's going to tighten the job market, right? That's going to strengthen the dollar. But on the other hand, tariffs are generally going to have a negative effect on the US economy, right? You get higher consumer prices, our exports get, nailed because the other party imposes, their tariffs on us. Chinese are not going to sit still, right? Then investment gets reduced because our tariffs our exports are weaker, right? So all of those are bad for the dollar, right? So there's both sides to the tariff agreement. And that's why on the screen I mentioned that tariffs could mean a stronger dollar and a weaker dollar, just at different points in the Trump presidency. What I can say is that most people agree that the short-term impact is going to be positive. And we've seen that the dollar's going skyrocketing, right? And the reason for that is because of our status as the reserve currency, safe haven. Trump brings with him massive economic uncertainty, massive geopolitical uncertainty. He brings with him basically a reset in American politics, and all of that means uncertainty, and uncertainty means people fleeing to the safe haven currency, and that's what we've seen since the day the man got elected. And that's our presentation. Hopefully you enjoyed these thoughts. I know the chat must be blowing up with all kinds of people saying I'm crazy or things along that lines, and I'm ready for those. I'm ready for that, Anna. But by the way, we all have a poll up on the screen. Please answer the poll. It really, really helps us in terms of understanding your interest, who you are, what you're here for. So if you enjoyed the webinar, please do give us 30 seconds of your time to answer the poll, right? It's just a straightforward process, and it allows us to, focus our investment activity and offers appropriately.
I would say
All
we
right.
don't have people necessarily commenting too much about the presentation other than to say amazing, and someone saying they appreciate the neutral stance, but we do have some questions. So let's talk about deportation. So there's, talk about a mass deportation. So first of all, how will that affect the job market and unemployment, and, what effect will that have on the economy?
Sure. So, again, without being political, I can tell you what things are easier to do and what's harder to do. What Trump can do is lock down the border hard on the January 20th. He can do that immediately. He's a president. It will take years for that to, he could actually, almost shut down the border for several months or maybe even a year. So that is well within his control. Deportations are actually not within a US president's control. There is massive amount of legal reasons why I don't think that he's going to be able to deport people. Keep in mind, every American administration deports people. The Biden administration deported millions of people, right? But what he's talking about is deporting all of the different categories that we usually do not deport. So he's talking about additional deportations over and above what we usually do. And I think that's going to be very difficult for him. But the impact will be that he can definitely massively reduce the number of people that are coming into the United States every year. I'm a fan of immigration, but I'm not a fan of the kind of crazy, batshit crazy immigration that the United States has seen in the last 3 years, because we don't have the infrastructure to support millions of people just pouring over the border like this. It's completely crazy. And I think that this is one of the reasons why the Democrats lost the election. So I think that he's going to tighten it so that no new people come in for a while, or he's going to slow that down a great deal. But I think his ability to deport people is questionable, and I think that he's going to do some of that just for branding purposes and to keep the MAGA crowd happy. But I'm not so sure that he has the legal ability to do that at any effective rate. So we deport millions. We're probably going to deport slightly more millions, but it's not going to be massive numbers. I think that that's going to get tied up in courts for a long time. So the impact on the job market is predominantly from less people coming in through the door. And so definitely will tighten up the job market.
Okay, so then just adding on to that related to deportation, with less deportation, as you're suggesting, then we would not see an impact on rents and housing suddenly becoming so much more available because there's less people and millions of people got deported. Some people are asking about the impact of deportations on multifamily and rents.
Definitely a negative effect. So I believe that multifamily has massively benefited in the last 18 months. In fact, what's really saved us as a sector is there was such a huge amount of immigration. A lot of those people obviously can't afford to buy anything, so they tend to rent Class C apartments, which increases the Class C demand, which increases Class B, which increases Class A. So we've seen a huge increase there. So I would say if Trump, brings, the this to an abrupt halt, I don't think that he can really, get rid of billions of people or deportation in any short amount of time, but he can stop people from coming in immediately on January 20th. I do see it as a negative impact on rent growth and on occupancy. So there's people actually doing calculations of this, and we'll share those with you in the future in our future webinars. But we could see if rent growth was going to be 3%, we might see it being closer to 2% if he completely stops immigration, which I think he's capable of doing.
Can you speak about Elon Musk's crypto and US debt crazy talk?
It's crazy talk. I mean, but doesn't the United States need crazy talk? I think we all understand that this country is going to go bankrupt if we have $2 trillion deficits. There is no mathematical formula to get out of this, right? We are in a debt trap. So the fact that somebody is talking crazy talk is a good thing. He may not be able to implement it because the only way to significantly reduce the federal deficit is to attack Medicare, attack Social Security. I'm not even sure the Republicans are crazy enough to do that. Trump certainly isn't. So I think that what is going to end up happening is that he may not be able to attack either one of those two programs. He may be able to attack government. As I mentioned, 19.5 million people work in the federal government. If he does a 3% trim, which is certainly possible, I mean, the government is ridiculously overbloated, that's 600,000 jobs. In the big picture, 600,000 jobs is not a loss. The US economy produces 200,000 jobs a month, but it certainly would have a short-term negative impact. In long term, I think it would have very positive impact because we absolutely need to reduce our spending.
Will tariffs offset income taxes, and how will that offset inflation?
That's speculative. I think obviously we are going to have a very large amount of money come in from tariffs. Are they going to offset, any further income tax cuts? I don't think so. I mean, again, without going the whole Republican Democrat, I don't have a podcast. I'm not on TV. I'm just a real estate guy, right? So to me, when I'm looking at it, the last set of tax cuts did not create enough economic growth to pay for them. I don't think that this set of tax cuts will do it either. The rich will get richer. But isn't that always happening, whether the Republicans are in charge of them or Democrats are?
For the short term, does it make sense to buy multifamily value add apartments currently with high interest rates?
To some extent, I think that this is actually a time when you're getting lower prices. So my answer would have been more careful before the election. Trump is obviously going to be overall good for real estate, right? I mean, especially if he does all of his tax, cuts and he starts talking about accelerated depreciation. So my honest answer is, if you believe that he's going to bring accelerated depreciation back, you should absolutely buy real estate at this point in time. There's going to be a massive increase in prices once he does that. If he doesn't, Hard to tell if it's a positive impact or negative impact.
Why would people buy gold over real estate?
They shouldn't, but they do because they're afraid. Gold is an expression of fear. Gold is an expression of concern. It's a safe haven asset. It doesn't produce any income, but people buy it and they shouldn't. And the fact that more and more people are buying it, more and more pension funds and more governments should alarm you. And it alarms me.
Okay. How do we identify opportunity zones, and does Grow Capitus offer opportunity zone projects?
We rarely offer OZ projects. We're not your guys, to be honest, but there are, so you can ask your favorite AI software to give you a list of companies that rank opportunity zones. There are several companies that offer software to rank opportunity zones. I have personally found that their ranking is pretty good. So go out there, find those companies, they offer packages, and that allow you to find opportunity zones that you might like. But I would say don't pull the trigger yet, right? Maybe get properties into contract, but don't go hard on your deposits. Let's see if he extends the date, right? I remember he doesn't have to bring the program back. It's an active program, but it ends in 2026, right? So if he rolls the date forward to 2030, then just being in contract, the value of your land is going to go up.
Do you think all the provisions of the 2017 Tax Act that are set to expire on January 1st, 2026 will get reinstated?
No, but I think some of them will. I think the ones that are beneficial to richer folks are more likely to get extended than the ones that benefit poorer folks. Again, the Republicans haven't fundamentally changed. They're interested in making richer people richer, and now that they have a mandate and Democrats unable to stop them, I think that some of the stuff that helps the middle class is likely to fall by the wayside, and some of the stuff that helps the rich people is likely to get extended. At least that's what I think. I personally benefit from it, but I wouldn't want that to happen.
We had 100% and 80% bonus depreciation in 2022 and 2023, but value of properties still went down quite a bit. Why do you think it will change this time around?
Simply because the value of properties go up and down for a number of major reasons. One is depreciation. The other one is interest rates. Interest rates are bigger. So think of depreciation as a 200-pound gorilla and think of interest rates as an 800-pound gorilla. Well, the 800-pound gorilla beat the 200-pound gorilla in 2022 and 2023. Now interest rates are turning around. The Fed's cut interest rates by 75 basis points just in the last 60 days. And the Fed intends to continue cutting. They don't care about what Trump is doing until what Trump is doing actually affects inflation. And that is going to take a significant amount of time, which means that the Fed will keep cutting. So the 800-pound gorilla that was beating the crap out of the 200-pound gorilla is all of a sudden the buddy of that 200-pound gorilla.
And why haven't cap rates fallen more given interest rates are up 3 to 5%?
So I'm not sure what the question is. I'll
I think,
I'll just
why
answer
haven't I'll just follow answer the first part. Why haven't cap rates fallen more given there's been interest rates cuts?
The interest rate cuts have only happened in the last 60 days, and cap rates are falling now. So CoStar has publicly released information, so has Yardi Matrix, saying that Q3 was the peak of cap rates. This means that they expect that in Q4 this year, the quarter that we're in now, for cap rates to fall. Cap rates are a trailing indicator. It actually takes time for cap rates to fall. Why? Because properties have to be sold. So today, the property that's in contract will be sold 4 or 5 months from now. 6 months from now, CoStar will figure out the price. 7 months from now, CoStar will publish that data. So there's a lag there. They're falling. Cap rates are falling.
You mentioned oil prices likely to come down. Will this make oil and gas investments less attractive?
Sure, it will.
Will the EV industry be negatively impacted by the new administration, even with Elon Musk in the picture?
I think it's guaranteed that the industry will be negatively impacted. I'm not sure if Tesla will be negatively impacted. Tesla is the only manufacturer in the United States that actually makes money on EVs, right? GM loses $21,000 a vehicle. I own a GM, Cadillac EV, they lost about 21 grand on my car. Ford loses $23,000 a car. So I think what will end up happening here is, the $7,500 credit might be reduced or might be gone completely, and that obviously hurts Tesla. But you know what it does? It hurts their competitors, GM and Ford and Stellantis, a lot more. So I think net, I think this is going to be beneficial for Tesla.
Some people are asking about different markets. I'll just ask you three in general,
Sure.
states. Florida, how do you think the state of Florida will be impacted?
It's certainly nothing that he's talking about, impacts Florida in a better way. The negative impact is Florida is sucking up huge amounts of IRA money to build seawalls and other kinds of things against climate change. That money is going to be gone. So negative impact.
Texas.
A very positive impact. Firstly, as I mentioned, Mexico is going to become a much bigger partner of the United States as soon as tariffs are implemented. Texas is obviously, got the biggest border. So there's also a lot of manufacturing. The way that manufacturing works is the one that requires, simpler manufacturing is going to be on the Mexican side of the border. The one that requires complexity is going to be on the US side of the border. And it makes sense to keep it all close by because of, because of shipping costs. So I think Texas just benefits in a lot of different ways. Texas is also the biggest beneficiary of the all the oil regulations being lifted. So Texas has a dual benefit, right? So it has a benefit from the tariffs, and then it also has a benefit from the oil increase.
Okay, last one, California.
Definitely negative. California was using a huge amount of IRA funds to build its train. That there's this, $68 billion public train transit project. There's a very large project being built in Los Angeles that might either easily run out of money when Trump takes this money back. California is the largest user of EVs and the largest beneficiary from EV subsidies. The $7,500 subsidy, the state that uses the most is California. So, a lot of negative impacts on California.
All right, we are at time. I don't know if you want to look and take one more question, Neil.
No, I think we're good at the hour level. Well, nice to have nearly 400 of you still listening at an hour's point. So hopefully this was beneficial. Just as a reminder, No Way But Up is a very interesting webinar. It covers a lot of content that we didn't get to cover today because we were staying Trump specific, and we'll send you an invite out for that. If you were registered for it already, you are still registered, so you'll see reminders coming on it for it. And if you have other questions, feel free to send an email to us. My email is on the screen, and so is my phone number. And so thank you everyone for attending.